Hi, this is Brian Dolan with the law firm Pepper Hamilton. Recently, Pepper partner Greg Nowak hosted an investment management webinar for West LegalEdcenter. For this session, Mr. Nowak was joined by Jim Kerr, Managing Director at Rockport Investment Partners, and Andrew Halperin, partner at EisnerAmper, to discuss the valuation of assets held by funds, of interest in funds, and of the managers' GPs at carry. You can download a copy of the PowerPoint slides used during this webinar by visiting the Insight Center at Pepper's website at www.pepperlaw.com, where this podcast is posted. Thank you.
Thank you very much. This is Greg Nowak. I'm a partner at Pepper Hamilton in the New York and Philadelphia offices, and today we're coming live from New York with two of my colleagues, James Kerr from Rockport Investment Partners and Andrew Halperin, a partner at the accounting firm of EisnerAmper. And our topic today, as mentioned, is valuation issues for investment managers in both hedge funds and private equity funds, as well as valuation generally from the point of view of the accountant. So before we get started, I wanted to recount something that happened to me personally. This was about 15 years ago when I was a senior executive at an asset management firm, and I was asked by my firm to go to China and to speak with a firm there about potentially making a significant investment in the firm. And while there, and I know the rules have changed a little bit, but back then it was somewhat inscrutable, we were told that we would have access to the A shares. And I said, okay, tell me about the capital stack of the company. How many other classes of shares are there? Oh, there are B shares, but they're exclusively for the Chinese. I said, all right, well, what's the relative value and worth of the A shares versus the B shares? Well, we tell you what you would get as an A shareholder, and that's the number you get, and therefore that's your value, and everything else belongs to the B shares, the Chinese holders. I said, so this is a preferred interest. Oh, no, it's not preferred. At which point, I related back to my employer who said, I think we should pass, which of course we did. But it shows the importance of valuation as well as an understanding of what it is that you're buying. Now, of course, the rules have changed. Things have become a lot more standardized. The rule of law is incredibly important in an efficient operation of the securities markets, but also since much of what we invest in these days is illiquid or perhaps not traded or not listed, private investments, understanding valuation and valuation methodologies and how those valuations are then reported to investors in commingled context is very, very important. So that's the genesis of the valuation program we're dealing with today. And so first I'm going to ask Jim Kerr from Rockport to tell us a little bit about himself and his firm, and then we'll turn to Andrew.
Okay, this is Jim Kerr. I've been in the valuation business. I own closely held businesses and securities for 35 years now. My latest affiliation is with Rockport Investment Partners. They're based in Connecticut and provide valuation as well as merger and acquisition advisory services and other business consulting services. I'm focusing on the valuation end.
Andrew?
Hello, good to be with everybody. My name is Andrew Halperin. I'm a partner at EisnerAmper. I am in the financial services practice, and I focus on private funds, including hedge funds, private equity funds, and funds of funds. And EisnerAmper is a full-service accounting firm. We're one of the top 15 or 20 firms in the nation. We do audit, tax, consulting services, and again, I'm in the financial services practice, and we also have a commercial services side of the practice as well.
Okay, well, obviously, if you have accounting, valuation, or legal needs, please look to one of the three of us for assistance. Without further ado, let's move into our slides and our presentation. Just a reminder, as was noted earlier, if you have any questions, please forward them through. We do have a screen here, and I periodically press the refresh button, so hopefully if you do have a question, it will pop up here, and we'll be able to address it during the course of the program. Don't wait to the end. We'll address questions along the way. So turning to slide number 3, the introduction slide, Jim, tell us a little bit about, what you see and why you get engaged for purposes of providing a valuation.
Well, as I've outlined here, there are two main purposes for valuations. One is for tax purposes. If people are doing a taxable transaction, if a gift or an estate is an issue, or it's just a taxable transaction, the transferring assets. And the other is for financial reporting, which goes back to figures being justified for financial statements and for regulatory purposes as well. So you get those two types of purposes, and there are some small differences in what you look at from a valuation standpoint for tax and financial reporting, and obviously you're being reviewed by different parties. But when it comes to the approaches and methodologies you use for valuation, they're just about the same, regardless of what kind of valuation you're doing.
Well, what are the important things, and we've turned the page now to the slides, standards of value. One of the important things to keep in mind when you're doing a valuation of an asset that does not have a market mark is the purposes for which the valuation is being conducted. So, for example, if you have a manager who has grown up in a very large organization and they've been granted stock options, they know the value of those options instantly by looking at the stock price from the newspaper or the internet, and they measure the intrinsic value of that option based upon that. So someone coming from a very large organization tends to look at value of a financial instrument in terms of a fungible asset. All of them have the exact same value. You may have a very infinitesimal percentage ownership interest, but whatever that is easily determined. Versus a private company where theoretically you could have the majority interest valued one way and the minority interest valued a different way for different purposes, right?
That's correct. If you're looking at, for valuation, particularly for tax purposes, there's a big difference between the valuation of an interest that's part of a controlling interest and the valuation of an interest that's part of a minority interest and has no control. Because you have not only issues for control, but you also have marketability issues, particularly with a minority interest. If you have a minority interest in a closely held company, it's very, very difficult to sell that, if not impossible. It can be very close to impossible to sell an interest. If you have a controlling interest in the firm, then you have, even with a private company, you have the option to sell that, to sell the whole company, assuming you have enough of the firm to do that. And that enhances the marketability of your interest. That also means that you can actually go out and realize what a controlling interest person would pay for that, and oftentimes the value for controlling interest can be easily be double what the value for the same share is on a minority interest basis. And people don't realize that, but that's the way these closely held companies work. Is if you have a minority interest, it's worth a lot less per share than it would be if it was part of a controlling interest.
So the exact same ownership interest, but a different percentage, results in a fairly material difference in value.
Yes, it does.
Or could result in a fairly material difference in value. So looking at your standards of value here, you have for tax fair market value, the traditional one that we all know, a willing buyer and seller, neither under compulsion to buy or sell with reasonable knowledge of the facts, versus financial reporting, which is fair value. And so how do these two differ in operation and practice?
Well, not an awful lot. The asset is either liquid or it isn't, and that's the same whether it's for financial reporting or for tax.
Something could be liquid, meaning you have willing buyers and sellers, but you don't have a market where there's a quoted price.
Well,
that's an important point. You can't necessarily equate liquidity with an objective price, right?
Right. Well, if you have an asset where there's a market for the asset, then the market is what prices that asset.
That will price the asset.
Okay.
Right?
If you don't have that, then you have to look at perhaps at comparable securities that are publicly traded, that are similar to your privately held security. But you also have to take into account when you price that off the public security that someone could sell that public security and get the money in a few days, whereas the private security, that might take a while. That might take you 6 months. That might take you a year to sell it. There might be buyers out there, but it's a whole process you have to go through to find them and negotiate it. And the price that you will get for will also reflect the fact that whoever you're selling it to is going to have a difficult time selling it as well.
So a liquidity discount.
So there is a liquidity discount, and those can range, something like 30 or 40% off of a fully marketable value.
So now the interesting thing is, I've been involved with certain parties trying to create a secondary exchange for some illiquid assets, and everybody has a different idea of what they're trying to do. And finally, in frustration, I said, wait a minute, we're going to define our terms here. A market does three things, right? A market gives you price discovery, it gives you marriage brokering, and it gives you fulfillment. So if you think in terms of a bulletin board or an open order book, a market can be operating with people putting in bids, or you could have, bid-ask spread where it's not actually everybody seeing each other, but an open order book is the best. That gives you your price discovery. But then you also have the opportunity to identify bidders for both selling and buying, and that gives you your marriage brokering, so the right price and the right terms in order to actually complete the trade. And then what's the beauty of our automated markets, like New York Stock Exchange or NASDAQ or ARCA or something like that, is you actually have fulfillment. So it's automatically transferred with the exchange acting as the guarantor on both sides of the trade. You don't necessarily need the third piece, because the parties can do what they do on eBay. They press a button, they say, okay, how do I, move my piece of tchotchke to you in exchange for payment on PayPal? So, there is a way to do fulfillment that's not automatic. But the two other elements, price discovery and marriage brokering, are two essential elements. And when you don't have both of them, that's when you need Jim, right?
Right. Well, you need someone to come in and make it a credible, independent estimate of the value, and there has to be somebody that not only has the expertise to do that, but also who has no interest at all in what the value comes out to be. So an important thing as an appraiser is that the fees that you receive are not contingent upon the value that you get, that you conclude. And for very obvious reasons, that's a very important factor. I cannot take a percentage fee of the asset value, because then I clearly have an incentive to come up with a particular value. Whereas if I'm just getting a flat fee or just getting paid hourly for my time, then I come up with a value and I have no stake in that value. And that's a very important part of evaluation, having credibility.
Independent, objective.
Right. And I don't have any financial interest in what the value comes out to be. That's important.
So talk about the valuation approaches that, are normally applied here.
Okay, well, there are always, and no matter what valuation you're doing, there's three different ways to look at it. One is a market approach, and that is getting an indication of value for a business or a security interest by looking at what other people are paying for similar interests.
So that's sort of the open order book concept.
Right. Or if you have a closely held company, you might look at comparable publicly traded companies to the extent that you can find them. And oftentimes there are publicly traded companies that are reasonably comparable to your subject company, and you can see what kind of multiples do they trade for and why, and where would this subject company fit in with that. Therefore, if it were publicly traded, what might it trade for? And then if you're valuing a minority interest, you've got to discount it for the fact that you're not valuing liquid shares, and the value you come up with is as if it's liquid. And then you discount it down from there. Again, usually a 30 or 40% discount off of that for lack of liquidity. And that can be, any market approach, people commonly think about, if you're selling a house, you look at market comps. Well, if you're selling a business, you also look at market comps. So what are people buying and selling these businesses for? And that's a good indication.
Doesn't that analogy, argument by analogy limp? Because, you might say, I've got a house in a particular market, but, I have 6 bedrooms. The largest other houses that are quote-unquote comparables are 4 bedrooms. And
well,
therefore, looking at market comps is going to materially undervalue what I have.
Well, that's why you also have other approaches, because the market approach can be very strong, very powerful, but it doesn't always work well. If you don't have good comps, it's not going to be that strong an approach. It can give you some indication, but not a great one.
Well, you have to expand the size of the neighborhood.
And you have to adjust things for the differences between the company you're valuing and the companies you're using as comps. Usually, a private company is going to be much smaller than the public comps, going to have a lot less management depth, probably not be as geographically diversified. So these are all negative factors that are going to bring that value down compared to the public company.
Or adjustments concerning growth rates and just the inherent risk in the business.
Right. You know, how do they compare to these public companies in terms of growth and prospects and so on, and figure out where would it fit in terms of this range of multiples that you see on the public companies.
And there is sort of a presumption of fungibility when you're talking about comparables that may not take into account the secret sauce that a particular manager has, right? I mean, this guy may be the second coming of, you know, the algorithmic guru, and if you can't figure out how to value that, comparables are really a limping analogy on that.
And
all right, so let's, you know, we understand market. How about income?
Now, income approach, then you're looking at the underlying income. The most common methodology under an income approach is the discounted cash flow approach, which I'm sure people are fairly familiar with. And there, you know, you have the company, and as an appraiser, I'm not going to do a projection for you. I'll go to the company and say, you guys got to do this. And then as an appraiser, you look at the projection and see if it makes any sense to you. Some people have quite optimistic assumptions about what they're going to do. Often they're called hockey stick projections. Somebody shows me one of them, I have to say, you've got to be kidding me, or else I discount it very heavily. And
what about somebody who tries to, you know, reel you in a little bit with a J curve, you know, where it actually shows it going down a little bit before it goes up like a hockey stick?
Well, you know, then come your 20 questions to the guy. Well, exactly why do you think this? And you know, if it's been done carefully, well, the individual may have a very good reason for doing that. Exactly why that is. And, you know, then you have to determine, well, what kind of risk is involved in this and come up with a discount rate, and that's a whole other exercise that I won't get into here, but it has to be a reasonable rate of return on this investment given the risk involved in the business and also the risk involved in the projections. I mean, do you really think they're going to hit these numbers?
So you're encapsulating in the discount rate all of those things.
All of those things.
Liquidity management, you know, success of the venture, the quality of the business plan, track record, all of it in one number.
And then the best outcome is where you do both a market and an income approach. I don't like using just one approach on any valuation because each one has its strengths and weaknesses. But if I have a market approach and an income approach, and without much work they actually sort of seem to be indicating a similar value, then I have a lot more confidence in the number because I'm coming at it from two different angles. Okay, here's what people might pay for this in the public market and discount that down, and then, okay, well, let's look at the company itself, say, oh, let's discount that back, and if I come up with something similar, then, okay, that gives me a lot of confidence.
Okay, so
unfortunately what happens sometimes is those approaches come up with very different numbers, and then you need to go back to the drawing board and figure out which reconcile them somehow. Okay, or maybe my discount rate's too high or too low, or maybe I'm not discounting these multiples enough because the projection isn't that good, the prospects aren't as good as I thought they were, and you find a way to get those two to tie together.
What about cost?
Now,
I just said, I'm a fund. I buy all these illiquid assets. Maybe it's it's debt instruments that don't have a market, whatever it might be. And I say, they're short term. They're really immune to the movement of interest rates in the marketplace. All I really have is a credit risk factor, but I think I've compensated for that by having a very high interest rate. So I'm just going to value it at cost.
Well, that's a fallback. Sometimes that'll be a good indication of value. Sometimes not. It's very hard to tell. Usually, an asset basis approach is an appropriate when you've got an asset-rich company like a company that mostly owns a lot of real estate. They're a real estate investment company, and oftentimes the way to value a company like that is to have separate appraisals, market value appraisals done of the underlying real estate, and then use that to compute net asset value, substituting in the market value for the book value of those assets, and coming up with a net asset value. That's usually only appropriate in like I said, in a company that's really asset rich, and then you want to look at it that way.
So looking at a life cycle of a business, you could have the startup, you could have operating, everything's going well, and then you have what I couldn't believe it, Westinghouse went bankrupt, filed Chapter yesterday.
Right.
Bankruptcy.
Right.
And so now all of a sudden, are all bets off in bankruptcy? Does it end up with huge discount factors just because? Or is there still an application of the same principles in these level 3 hard-to-value assets?
It's the same principles. Usually, I mean, the values are discounted from what they were carrying on that, but probably that value was lost well before they went into bankruptcy. The bankruptcy just sort of recognizing that this had happened, and that in fact they for whatever reason they can't pay their bills, and that's why they go into bankruptcy. And that usually means the assets have lost a lot of value. Either they can't sell them in the marketplace at a decent rate, or the income has dropped significantly. And that's why they're going into bankruptcy. So when that happens, yes, the asset values have come down. And then you're looking at more liquidation values, and those are always discounted heavily because just the basic human nature, when someone knows you're liquidating, all the vultures come in and bid the price down.
Well, all of us are old enough war horses to remember 2008 and 2009 when prices, well, maybe not you, Andrew, but
old enough, I just put it out of my mind.
Okay. But, you had firms that were holding assets, especially that were in warehouse lines about to be put into collateralized debt obligations or CDS or other, synthetic structures. And the investment banks refused to sell those assets because the vultures, as you were saying, are pricing them down so low when they knew there was such intrinsic value in those underlying assets. To sell them would be a breach of their fiduciary duty. But they had no choice. They needed cash, and so ultimately they ended up, in certain instances doing that.
Right. Well, I mean, when you get in that situation, you've got to sell the asset. You got to get something for it. And if people know that you have to sell the asset, then it costs you money to sit there with it, then they're going to bid it down. And at some point, you're just going to have, the more time goes by, the value is not going to increase. It's going to go down. So then liquidation values, they're heavily discounted values. And that's why, in a bankruptcy, the equity holders don't get anything. And the debt holders are lucky to get 50 cents on the dollar.
Well, it depends on the bankruptcy.
Depends on the bankruptcy, yes. But the debt holder, the equity holders usually will get nothing, and the debt holders usually have to take a haircut. Because that's the only way. That's what usually when those things shake out. And a lot of people took some big haircuts, certainly in 08, 09, because of that.
So let's shift gears a little bit and talk about favorite topic, dividend recaps and how they work. In particular, when you're dealing with the valuation of general partnership interests in private equity and hedge funds. Tell us about that transaction or the typical transaction.
Well, a dividend recap is something that you'll see private equity firms doing with their underlying companies. And it's an interesting time. A dividend recap, they call it. It is a recapitalization of the firm that the private equity firm is investing in. Mostly it's leveraging the firm up. If it has borrowing capacity and you can get a bank to loan you the money gets loaned to the underlying company, and then the media goes right out the door to the private equity investors.
So I have a portfolio company, obviously a strong enough credit that a bank is willing to lend to it.
Right.
So I lever up the balance sheet of that company with debt, take the cash, and I then use that cash to make a dividend payment to the owner, which is the private equity fund. And then the private equity fund, of course, takes that cash and puts it in the pockets of its investors. Now, my remembering is that in order for a company to pay a dividend, it needs earnings and profits. So there's an assumption that either that company had historical earnings and profits or current earnings and profits, because if it doesn't, then that return is a return of capital to the extent of basis, and then it's capital gain. So theoretically, this is a way for a fund, right, to get out its invested capital on an accelerated pace. And if it's invested capital as opposed to earnings and profits, then it's a very tax-efficient answer, right?
Right. And oftentimes the reason the dividend recap is done is because the private equity firm figures out that they can't get the price that they're hoping for that company right now if they wanted to sell it. But they have, and maybe it's beyond the time that they were hoping to hold it, which happens sometimes, and so they have investors that want to get some payout. So the way they do it is they do a dividend recap. It can become a bit expensive because you have to pay for a solvency opinion when you do that. And those
which is another form of valuation opinion.
Which is a valuation opinion also that says that the firm will, after the transaction, its assets will be greater than its liabilities. It will be able to meet its future obligations under debt, and that it's not unreasonably undercapitalized. And those are the three tests that you have to run as a solvency opinion, and those fees are generally, the fees for those are generally in six figures because the appraiser rendering the solvency opinion has some liability associated with it if the company then goes under because they levered it up too much or used much rosier projections than were reasonable to say, oh yeah, they can pay off their debt, and then the company hits a downturn and then things can go south. But that's another type of valuation opinion. It's a solvency opinion associated with the dividend recaps, which have been very popular in the last few years.
Interest rates have been low. Interest rates have been
low. Well, yeah,
right.
You can borrow the money easily, yeah.
Right. Well, but that's an interesting question. So the use of proceeds, disclosed to the lender, of course, is that the proceeds will be used to pay a distribution to the owner.
Right.
And will not be available inside the company for, discharge of the debt or expansion of the business.
Working capital.
Or even for working capital.
Right. In the business, yeah. I mean, it won't be available. That's correct. Usually this only really works well when you've got a private equity investment and the company isn't very levered to begin with. Maybe 10% leverage or something. And then they can bump it up to maybe 30 or something. But you get much higher than the 30 or 40% leverage, and then the banks are going to start to say, now, wait a minute.
Can the company carry the debt?
Can the company really carry this debt? But if you're only leveraging it up to 25, 30% leverage, then a bank and the lender's like, let's say, okay, these guys can probably pay this off. But it gets some pretty close scrutiny, and the solvency opinion, that goes through several levels of review because there's a lot of money on the line here as to whether these guys can pay it back. And again, it's money that debt that they're taking on that's not going to be invested in the business.
Right, normally going out the door.
Going right out the door.
So let's talk now, shifting gears, looking at the fund itself, whether it's a private equity fund or hedge fund, and the valuation of the general partnership interest in that fund. Now, following a typical structure, the carried interest or incentive fees that would be paid by the fund to the manager's complex, those incentive fees or carried interest would be going to the general partner because it owns the equity interest in the partnership. And it's basically being paid that incentive fee as compensation for the fact that it's backstopping the risk inside the entity, right? As the general partner, it's liable for debts in excess of the limited partner's contributions. So the general partner gets that share, and the investment manager normally receives the fees for the actual rendering of the services on a regular basis. Oftentimes, especially in privately held general partners, or closely held ones rather, the CM of the firm will want to pass some of that on to the next generation and do it on a tax-efficient basis. Mm-hmm. So how do we value those general partnership interests for purposes of estate planning, gift planning, or what have you? So for those following along, we're on the examples pages. Example of private equity carried interest. Jim, away.
Well, since these are closely held interests, and I can tell you right now, you will find no publicly traded interests out there that compare to these. So using a market approach is not going to work because there are simply no market, and there's no comparables for these either. And the first example there, these are both quite simplified to make it easy to follow. You have a private equity firm, and we're assuming that investment is made, and that the assumption is that realization of that investment will be after a 5-year period, which is a common time period that private equity firms like to get out of an investment. Whether they will or not is another thing, but we're going to assume a 5-year holding period. And we're assuming an average return, an internal rate of return on the investment of 12%, which is not particularly high or low, but it's really sort of a minimum kind of return that you're going to have to see in private equity firms in order for it to work. So we've used that for this example. And as often happens with these, the LPs get two things before you get to the carry. First, they get their investment back. In this case, that would be the 100 starting in year 0. and they get a preferred return. So they're guaranteed some return. In this case, I just use 5%. It can be 5 to 8%. It varies depending on the investment in the fund. So you'll see on the top line there, after 5 years, that using the compounding the 5% return, that 100 is up to 128. So that's what the LPs have to get back after you sell your investment before you get any carry. And so, assuming you sell the investment for the 176, and a little rounding here, but you end up with the net of 128, you get the amount that's subject to carry. And that would be the remainder of the 49. So you take 20% of that, that's the carry. But then realizing this is 5 years out, 5 years from now, so you have to discount that back to present value. In this case, I've used a 25% discount rate. Now that's a rate based on a lot of different risk factors, including the track record of the fund, the risk involved in actually having this investment get a 12% internal rate of return, the risk involved in actually being able to sell it after 5 years. It might be 7 years, it could be 10 years, it might be 3 years, you don't know. But all these assumptions go into that, and so there's a good fair amount of risk associated with getting this carry and certainly getting the investment. So a 25% rate of return is right in the ballpark of where we usually...
Fairly typical.
Fairly typical.
Yeah.
You might get a little higher, a little lower. If anything, it'll go up from there rather than down.
But all of those factors, all of the liquidity factors, the lack of marketability factors, the fact that it's 5 years delayed, everything is built into the 25%.
Right. So then when you end up with is this carried interest today is only worth a little more than $3 million. Now that's a gross value, and that's if someone's making a gift of that, if it's a minority interest in the fund, and it's not, and then you have liquidity discounts that can be applied to that $3 million. So what this means is this person can take a payout that's made potentially $10 million at the end of 5 years and gift it for us for a fraction of that today. In which case, with the $3 million, it would be discounted probably down to less than $2 million, and that would be the basis for a gift.
Now, this methodology is different than what you would use in a hedge fund, which is in the next slide, right?
Well, yeah, in the hedge fund, you don't have this you don't generally have a preferred return set up. You might, but probably not. And there isn't the return of capital that comes before the interest. It's more of an annual thing. Okay, I earned you 12% on the fund this year, and I get 20% of that as the GP. So that's the 12 is what was earned. The investment earns the fund. The GP gets 2.4, and this is assuming. And then we're capitalizing it at a 25% to get up to a 9.6 number. But mind you, that's capital. This is assuming present value basically has a perpetuity. But understand that if you're capitalizing at 25%, basically you're saying it's about a 4-year thing. And that's as far out as you're really projecting. After that, the present value becomes de minimis. And sometimes on these hedge funds, the 25% is actually at the low end of rates I may use, because more often than not in hedge funds, you've got a lot of risk associated with just a few individuals really calling the shots on the investment management, and you have a real dependence on some key people there, and that's a real risk factor. Because these guys can, they sometimes, they make enough money and they're 35 years old and they retire, and, the whole thing goes away.
But on the other side, you have the fact that it's actually periodically paid. So
right, it's paid every year.
So there is a degree of certainty that you don't have in the 5-year model that you're looking at on
the only thing that might hurt that is, and I'm sure hedge fund managers know about this, is what's called a high water mark.
Right.
And that is, let's say during the year you start out at 100, and then the investment appreciates, let's say up to 112, and you take your carry, and then the next year it goes down to 80. Well, that means when it comes back up, you're not going to get any carry until you hit that number that you were at before. And sometimes, if somebody's that's a hedge fund manager who's underwater and isn't likely to see incentive fees for a while.
Well, hold on.
And that's a problem.
He's not going to see incentive fees on old money.
On old money, no.
The new money that comes in when that asset's at 80, he's going to get an incentive fee on that.
Yes, he will.
But that's an important thing that hedge fund managers often miss. That if you have a liquid strategy where assets are coming in the door, you actually refresh your high water mark because the high water mark is unique to each individual investor.
But if investments went down to 80, you could see investments going out the door too.
True.
So
but then that becomes the counter-cyclical buying opportunity, right? Where the investment manager is selling to his client, saying, "Hey, you come in now because we're at historic lows," right? It's like buying a stock that normally trades at 15 at 3 because why? The market's down, but there's no real fundamental reason why that particular stock is down.
Now, when it comes to the average rate of return, that's you may understand the return that you're assuming in this model is very important. Again, I picked 12% mostly because, in my experience, that's really the low end of what a hedge fund manager needs to get if he's going to keep his investors.
Right.
So if you're doing valuation, you have to make assumptions that would make it so that we're continuously going concern. Because if he's only hitting 5%, the investors are gone. Because there's too many other ways for them to make that kind of money without taking the kind of risk, or paying somebody 20% of the profits.
Oftentimes what will happen is there'll be a hurdle rate or a risk-free rate
that
investors demand before you get your carry. And that's a way for you to it's a point, almost like a point spread in a football bet. Well, how do I draw out money? And one way to do that is with risk-free.
Well, sometimes what they'll say is, all right, you have to at least a treasury bond rate for me. And then until you hit that, I'm not paying you an incentive fee.
Right.
And in some funds, they'll only get paid a fee on the amount that they get over that. On other times, all they have to do is hit that number, and they get 20% on the whole thing. It depends on the structure.
So the difference in the value of the carry between the private equity example and the hedge fund example, the $3 million versus the $9 million, you can see the preferred return of 5% in the PE model
really killing it.
Really makes up a lot of the difference, right, Jim?
Yep. Yes, it does. Yes.
Yep. All right, I want to shift gears here and go now to dovetail with the Chinese example from 15 years ago that I had mentioned, and that is the presentation of the information from the fund and the role that valuation plays in the construction of the financial statements. So, Andrew, when you're preparing audited financial statements for a fund, whether it's private equity or hedge, the manager is registered with the SEC. We now know the custody rule requires, if they want to sit within the safe harbor, that they deliver audited financial statements in accordance with GAAP with no reservations within 120 days.
Right.
So, what role does valuation play in the delivery of those statements?
Well, valuation's a key area, maybe the most critical area. When we look at our audits and where we look at key risks, particularly on funds that are holding illiquid or hard to value or level 3 types of investments. That's where we'll spend a good amount of our time, and there are a lot of challenges depending on the complexity and illiquidity to the types of investments in the portfolios. In the end, our objective is to determine a value that is reasonable within a range of fair value. We don't look at it like there's one right answer. Oftentimes, people think that as auditors, we're just looking to make sure that the investments are valued very conservatively, particularly when you have a hedge fund and investors are coming in and out. We're really more concerned that the value appears to be within a reasonable range, and different types of investments will have different types of reasonable ranges. So obviously, the more liquid, exchange-traded types of investments, you'd expect very little tolerance level within, say, a few basis points of any kind of an independent source. As you get into the more illiquid investments, say real estate, there could be a range of 10%, 15%, maybe it's more. And then ultimately it's management's determination as to where the best estimate within that range falls.
Well, oftentimes people will say, well, thanks, Jim, for all of your all your valuation opinions, but what do the auditors say, right? And how is this going to affect my financial statement? Will I get a clean opinion? So where do you start? You start with the process. You start with what the manager does normally, and then, walk us through the testing model and everything else as you prepare the audited financial statements.
Right. So we are auditing, reviewing the valuations from the funds.
So let's take an example. Let's say you have a fund that invests in illiquid debt. There is no secondary market for this illiquid debt. The manager looks at it and says, very high coupon to take into account of the risk. I've got a rule of thumb that if somebody's 30 days late on payments, I drop the value of that instrument by 50%. If they're 60 days late, I drop it to zero. So that's my rule of thumb based on my experience as manager of how I'm going to value my overall portfolio, but individual names get valued that way. Everything else I carry a cost.
Okay. So on the surface, that process may not necessarily get you to fair value as we defined it earlier in the presentation. The fair value is supposed to be what can you sell it for in the market, orderly transaction on that measurement date. So policies like that may not get you to that definition. You may be able to show that cost approximates fair value, but you're in effect determining that cost is fair value. When we see debt investments like you're describing as valued at cost, it's often because the client says, well, we made the investment in, say, the last 12 months or so, maybe it's the last 6 months, maybe the last 3 months, and nothing's changed. Well, we need to see support as to the fact that nothing's changed. So has the credit quality of the borrower been consistent? Has it changed since the time of the purchase? Does the balance sheet look the same? Are the financial operations, the performance of the company consistent with the type of performance when the deal was underwritten at the time? Then have interest rates and credit spreads been consistent from the time that the investment was made to the measurement date? If all of those things can be shown to be the same, then in effect you could effectively back into the fact that the discount rate that was really used to underwrite the deal is still a fair input to theoretically a discounted cash flow type of model on that measurement date. So it could turn out that those policies may get you there, but just having policies that say we're going to write something down 50%, that doesn't necessarily show us that that's how market participants would look at it based on their required rate of return, if you think of it in the context of something like a DCF model, or when you have sort of a non-performing debt type of investment. That's where you get into some of the stories or the liquidations or the analysis of the collateral or the assets behind it. So the analysis really needs to evolve more from what you explained.
So again, I'm assuming the auditor does not want to replace his judgment for that of the manager. You're an auditor, after all, not a valuation firm, at least in this context.
We want to understand the valuation approaches and techniques and why they're appropriate as deemed by management, and we have to have a judgment call on whether that appears reasonable, whether there could be other alternative methods that may seem to be more appropriate. We look at management's inputs and assumptions, and this is the big thing. This is what it normally comes down to with these hard-to-value illiquid types of investments. And how did they determine that those are rational and can they be supported? And if they can, then we're happy to agree that those appear to be reasonable inputs. We try to do more of that and get an understanding of what the expert front office types that are doing the valuations, hopefully with some kind of independent verification process at the firm, more than us just going off and doing our own independent analyses. When a firm like Jim's is engaged by our clients, it's a great package for us to review because it tends to be a better documented product as to the valuation approach and how all the assumptions and were supported and how the conclusions were ultimately reached.
And certainly, as an appraiser, I would recommend everyone go hire a valuation expert.
And I do too, because it makes my life easier.
Particularly when you're dealing with financial reporting and the auditors, because they're going to have a lot of questions. And and as an appraiser, I can tell you that I've been through the reviews from accounting firms. And some of them can be quite lengthy and actually kind of grueling, because, they come up with 40 questions because they want to know all the answers to these questions. And if you've done your work properly, it's just a matter of going down and answering the questions. And most of the time it's done in writing, and it's, they send you written questions and you answer them. And sometimes you end up on a phone call with them and try to explain to them. But it just takes management out of the process, and then you've got somebody independent saying, we think management is right, or we think these are what the numbers are, and then the auditors can have something that they can review. And oftentimes auditors will have a valuation group within the auditing firm. I know EisnerAmper does, and oftentimes those are the people that will be reviewing your evaluation. Sometimes that can work out okay, particularly if you already know the people at the firm. And sometimes I've found myself being reviewed by people that I actually trained, which makes it a little friendlier than seeing my work before. But nonetheless, they're still going to ask 40 questions,
right?
And if you can't answer them, then you're going to have a problem getting your audit done. So the valuation practitioner comes in and helps you get through that audit process. Is basically what you're doing.
Yeah. So to that point, Andrew, you've laid out in 2 slides the audit support elements. And I want to do a deeper dive into that. So let's, create a paradigm. You have a private fund that's invested in illiquid debt securities. There is no secondary market. They are risky loans, but they're short-term. They have very high coupons. So, payday loans, if you will, if they were still around. That's a good example. So you have a portfolio of payday loans, high coupon, big turnover, relatively short. There really are no exchange-traded prices. They just don't exist. Broker quotes, maybe. You might have someone who actually can sell it, but they're usually not selling individual loans. When you have brokers involved, usually they're selling an entire portfolio of loans, and they're doing a securitization or a wind down or something. So it's hard to get individual loans from brokers. Pricing services. The pricing services would say cost, because the interest rate that's built into coming up with that cost number, and therefore discounting the present value of the cash flows they anticipated under the loan, is high enough to take into account the risk that you would be concerned about. So you have one, independent data point, a pricing service, reputable, in the business, cost. Valuation models. The manager says, well, we don't use cost. However, the methodology we do use approximates cost. So following your lead there. And then finally, NAV is a practical expedient. As of the fiscal year end, we will be making investor transactions. We're going to have new members come in, and we're going to redeem other people out. We will give full disclosure to everyone, and so they will know what's underlying in our valuation methodology, and so we'll actually have purchasers and sellers buying and selling interests that are derivative of these underlying values. It's now March. You have a month to get out the audited financial statements.
Compliance tomorrow.
Oh, that's right. And you're sitting there and you're saying, with the clients sitting on, the edge of their seat, hoping that they're getting their financial statements tomorrow.
Okay, so a few pieces to that. So first, cost is not fair value. The fair value definition that we've gone through. Cost is not, by definition, fair value. The second thing you said is another firm says cost may approximate fair value. So that's a more accurate way of describing it. And cost approximating fair value in the example of that loan infers that the required return or discount rate that a market participant would use in valuing that investment to make a purchase is the same as the rate on the loan.
And so
if you can support the fact that that loan or those a bucket of loans that may be in a certain type of credit bucket would require that kind of a rate, then cost in that fact may be deemed to be a good approximation of fair value. Then just to clarify on the NAV as a practical expedient, in the context that I was thinking of it and putting that on the slides, that really relates to fund of funds, which we haven't really gotten into more. But in your example, it sounded like you were describing an example where the fund that owns these types of loans may actually be sold in the secondary market.
Well, there'll be an interest coming. Investors will come in and investors will go out. Yeah, and let's assume perfect knowledge that whoever the investor is coming out knows what's going on in the portfolio. There's no hiding the ball.
Right.
And so whatever they're willing to pay, presumably, would be a proxy for, almost a market proxy for fair value, wouldn't it?
Well, investors are coming in and out at the NAV. The NAV is based on the underlying portfolio, so you need to determine what's the value of the portfolio first to really get to that point.
Yeah, but the fact pattern I'm suggesting is the transactions are going to happen December 31, and now here you are, at the end of March, essentially verifying values as of December 31.
Right. Well, the unit of account is different because in that case, and then that gets a little technical in terms of how fair value is determined, but what's being purchased in that example is the fund, whereas the unit of account that we as auditors are looking at is the value of the individual investments held by the fund, and there could be differences between those two things. So the investor in the fund could be thinking of what's the quality of management. They could be looking at other types of assets that are also held in the fund. So there's another layer.
Yeah, but the stark reality is, though, when you're investing in a fund, if the next day the fund, decided to liquidate, the investors are only going to get what they can get. That management value premium that you just described really doesn't exist in a private fund context other than in a going concern.
Now you're also introducing the topic of a liquidation value. And that could be different than fair value. So fair value is orderly transaction. It's not a fire sale. There's no need to get out right away.
Going concern.
Right. Right. So fair value is based on more of a going concern, orderly transaction. There's time to market it versus a liquidation, fire sale. You need to sell at some kind of a discount.
So we have about 8 minutes left, and in those 8 minutes, I did want to go through best practices that you've laid out here in and common areas for improvement that you've seen through your audit activities.
Okay.
So walk us through, what is considered, from the point of view of the auditor, a best practice in valuation when you're dealing with a fund that has potentially, illiquid or hard-to-value securities.
Sure. And interestingly, the best practices do have a relationship to the common areas of improvement for obvious reasons. So on the best practices side, it always starts with written policies and procedures. Regulators will look for this too. And really what's best is if that could be looked at on, by asset class, whether we're talking private equity, whether we're talking debt instruments. Sometimes debt instruments can be broken down to performing versus non-performing, forbearance agreements, really distressed, and descriptions of the approach. How will key inputs and assumptions be sourced or determined? That's all important for written policies and procedures. The next bullet goes into governance. There should be a valuation committee, some oversight into the overall process, an independent price verification process that's in place is definitely a best practice, although the role really of the front office, we like to think that the investors, the portfolio managers, are the people that know the investments best and know how to look at valuations and what they'd be willing to buy and sell investments at. So their role is critical, but ultimately you should have an approval that's done by some independent function that is less biased in terms of what the resulting valuations are. On things like broker quotes, there should be due diligence and back testing. That's pretty self-explanatory. Clearly should have oversight of third-party pricing services and valuation firms and their qualifications and experience, and are they changing methods or processes. When it comes to models, validating and recalibrating models is always important. But the most important thing on this slide is the documentation. And we talked about it some. To the extent that you could have a really good starting point describing the valuation approach, the technique, and then how key inputs and assumptions were determined, and including the support for those, whether it's EBITDA multiples, when you're looking at comps, if you're looking at PE, which comps are the most relevant, which ones are outliers. When you're looking at debt, how are you supporting the discount rates? So all of that kind of stuff, the borrower financials, analysis of the subject company. I mean, it really all starts with understanding the business and the developments in the business and what the financials and financial performance looks like. So to the extent that could all be documented well, which is the reason I go back to engaging those third-party firms that put it all together in a good package is really helpful. That's really the ideal.
But presumably, once you've been through this and you've been beaten up, as a manager, you study for the test. You know what you need, and next year your policies and procedures should be up to snuff, and your documentation should be stronger. Now, obviously, it's not going to be exactly the same as this year. There will be differences in the economy. Things will go in and out of favor. But presumably, you will be able to, narrow down some of those issues and, be adopting best practices on your own. So let's focus.
Great segue to the next slide.
Exactly.
Right.
So what are these common areas of improvement that you see, across your client base?
Right.
We have about 3 minutes.
Okay. And we've seen a lot of focus on valuation since the financial crisis, and we've seen some improvements. Where I think things can still be improved, I mentioned analysis of the subject investment. If we're talking about distressed debt, it's critical to have an update on how the financial performance of that borrower has been over the last year, and what's the current balance sheet look like, and what are the prospects going forward. The documentation of the methodology approach, we see, that's gotten better. But the support for key inputs and assumptions, we're still seeing, in my experience, a description of what those inputs are. So we might see we use a 20% discount rate, or we use this multiple, or we applied a discount of 40% on this. We see various assumptions described, but we don't have any rationale, and we don't have any supporting evidence, corroboration to get us there. And that's where we start to have to do a lot of back and forth. We talked about using cost as fair value. I still see that a lot without really any support as to why cost is still deemed a good approximation of fair value at the measurement date. Single broker quotes, that was a big issue around the time of the financial crisis and after. I'm actually still seeing instances where we'll get a single broker quote without really any insight or color into how the quote was determined. It could come from the counterparty. It's indicative, and I don't have anything else. We're always going to ask for more. We're going to say, find more quotes or do another type of analysis, but getting a single indicative broker quote won't check the box for us as auditors. I still see outdated appraisals or events being something like, well, we received an offer for the investment a couple of years ago for this price. All of that has to be updated or bridged. It doesn't necessarily mean a completely new appraisal, but what's happened since with the value of buildings in that location since that appraisal was done 2 or 3 years ago? Things like that need to get done. I still see some portfolios where there might be one-off or esoteric investments or a few in the portfolio that really don't get a lot of attention, so to speak. And sometimes what we wind up seeing is that the procedures are more robust on the audit sample, and the rest of the portfolio may not really be up to standard, which, if it's not in our audit sample, that'll be one thing. If the regulators are knocking at your door, that could be a whole other issue. And then the last bullet is, as we alluded to before, to the extent there could be a good, strong package up front, it'll make the process much smoother and less piecemeal and a lot less back and forth.
Well, I'd like to thank my co-presenters today, Andrew Halperin from EisnerAmper and James Kerr from Rockport Investment Partners. I hope you've enjoyed our program. Hope to see you next month in April, where our topic will be the SEC modernization outreach in plain English, decoding the regulation. Obviously, this is for our investment advisors who are subject to the SEC rule with respect to registered funds. But given the fact that so many hedge fund managers these days manage both registered products as well as unregistered products, we thought it worthwhile to focus on the SEC's plain English initiatives. Given some of the PPMs I've seen recently, plain English would actually be a good thing. So, without further ado, thank you for your attention. Have a great day.